Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at the possibly difficult journey ahead for the UK bond market, and my guest is Joachim Clement, Head of Strategy at Liberum Capital. Skyrocketing yields, sterling in a nosedive. The pain of the fallout from UK Finance Minister Kwasi Kwarteng's fiscal event late September is still raw for investors, after a dramatic week which saw the Bank of England forced to step in to restore financial stability. Its emergency bond buying programme did help bond markets regain some composure, and Kwarteng's decision to scrap a key component of his plan, uncosted tax cuts for high earners paid for by massive government borrowing, helped a little more, while sterling gained on that apparent U-turn. But there is still talk of possibly parity with the dollar ahead, amid shock over the impact of the bond market meltdown on the UK pension industry, on the UK mortgage industry and on UK PLC more broadly. So what next for the UK government bond market? Is this a time to jump in? If you're so minded, the iShares Core UK Gilts ETF offers one stepping stone. With a market cap of £2.46 billion, it's down around 25% year to date. Well, with me in the studio to share his thoughts on those questions is Joachim Clement, Head of Strategy at Liberum Capital. Joachim, thank you so much for joining us today. Standard & Poor's cut its outlook on UK sovereign debt to negative at the end of last week. Is confidence in the UK government's ability to manage the economy, has it taken terminal damage as a result of this event?
It definitely has taken a long-lasting and significant damage. The UK government and UK government finances used to be relatively stable and admired by the world, and especially the Conservative Party taking a wrecking ball to that has really irritated, if not panicked, a lot of international investors.
One big factor in the pace of selling was LDI, liability-driven investment, which forced pension plans to pay for margin calls on hedging investments. Why is LDI so dangerous in those circumstances, and what have we learnt from that?
So what pension funds do is they buy 30-year or 10 to 30-year gilts in the UK. The problem is when interest rates rise, the 30 years lose a lot of value and those pension funds are asked to post collateral. Well, if you don't have enough liquidity on the hand, you're starting to be a forced seller of those 30-year gilts, making the situation worse by pushing yields even higher and creating a death spiral that could ruin a lot of pension funds.
And around 1,000 mortgage products were withdrawn in the days following Kwarteng's fiscal event. Could we see that spiral into a deeper, wider problem for the UK property market, even possibly a crash?
A crash, we think, is very, very unlikely at this point in time. However, UK lenders will only come back and put those mortgage products back on the market if they have some stability and planning capability for interest rates. And that's why it's so important that the Bank of England stepped in to stabilise gilt yields.
So where does this leave the Bank of England going forward? Is its primary duty now to restore financial stability in the bond markets?
They can either save the gilt market by buying gilts and fixing or avoiding higher gilt yields, or they can try to defend sterling and the value of the sterling. You would have to do that by rapidly and aggressively hiking rates, which would cause an awful lot of problems in gilt markets and in the housing markets. And with their emergency measures last week, they, in my view, have done the right choice and chose to prop up the gilt market and let sterling, if in doubt, become even weaker versus dollar and euro.
How weak might it become? Is parity with the dollar, which has been much talked about, is that possibly on the cards now?
It's, in our view, definitely on the cards because we've looked for episodes when sterling was as oversold and crashing. And on average, it took 2 to 3 months longer for sterling to find a bottom after such episodes. And on average, the sterling weakened by about 6 to 8%. And that would put sterling on path to parity to the dollar.
So what is the outlook for the UK government bond market over, let's say, the next 6 to 12 months?
You've shown the chart of UK gilts, and they have come down a lot. Yet we think it's too soon to buy into this market yet, because with sterling being so weak, the Bank of England will likely have to hike interest rates, in our view, by about 100 basis points in November and another 75 basis points in December, meaning there's more downside until the end of the year. However, in the first quarter of next year, we could actually see a very, very good entry point as the Bank of England, as well as the European Central Bank and the US Fed, start to take their interest rate hiking speed down and relax a little bit on their hiking path. And that could already lead to a turnaround in treasuries as well as gilts.
But obviously the other part of that equation is some sort of restoration of confidence in the UK government. Do you see that happening?
It's all in the hands of the new government in the UK. The Bank of England has its hands full in stabilizing the markets and avoiding a financial crash. So the only people who can stabilize sterling and restore trust in UK PLC and in the UK government is the government itself.
Okay, well, Joachim Clement, Head of Strategy at Liberum Capital. It's been great to hear your views today. Thanks for coming into the studio. And that is your roundup of the UK bond market. I'm David Pollard, and this is Reuters.